When investing, it's best to have a strategy. Risk management is a key part to any profitable strategy. In today's video, we will reveal 3 risk management techniques used by active investors. Welcome back, investors, to Ticker Time News. I'm Adam, and all of the information we talk about today and more you can find on our website, tickertimenews.com. Again, that's tickertimenews.com. Let's jump right into it. If you're an active trader in the stock market, you need to take a proactive approach to risk management. The stock market can be a phenomenally profitable place to invest. Just think of all the Tesla millionaires that were created last year. That's a lot. That's a big number. But if just a handful of your stock picks are losers, you could end up with far fewer profits than you might have otherwise. By adopting a proactive risk management strategy, you can reduce the downside risks of the stock market while still enjoying the upside potential. But how do you adopt a risk management strategy? And what should that strategy include? Without a sound risk management strategy in place, even the most seasoned investor could lose all of their profits on just one bad trade. Active investors are most in need of a risk management strategy. Since they are frequent traders, they put themselves in greater danger of the occasional bad trade. Your sound risk management strategy should include a number of factors, and we're going to go over them right now. Risk management strategy number 1, planning your trade. It seems like something so obvious that nobody will do, but it's important. Every active stock market trader needs a plan, and it is important to plan your trades carefully. When you buy a stock, you need to think carefully about why you are making the trade. Do you believe in the company and plan to hold the stock for a long time? Or are you looking for a short-term trade and the associated profit? There's the idea, buy the rumor, sell the news, in investing that many base their trades on. This idea is a market adage based on the belief that stock prices move in anticipation of rumors and rebound when profit-taking occurs after the actual news is released. This can be a risky strategy for most stocks, but many growth stocks have a cycle that follows this adage. You don't want to miss risk management technique number 3. It's the easiest one you can do, and you can do it right in your Robinhood brokerage account. Risk management technique number 2, take profits as they come. Some of us are scared to take profits when we're investing in stocks because we don't want to miss up on any of the upside. But a lot of times when we use that strategy, we end up losing out more than we could have possibly gained. Stock market investing can be extremely profitable, but too many investors have watched their profits slip away. If you want to reduce the inherent risk, you need to take profits as they come. Tracking your investment results and reaping profits when you can should be part of any sound risk management investment strategy. You do not have to sell your entire position, but looking for any exit point for your riskiest holdings makes a lot of sense. Another adage is lock in profits and play with the house's money. Jim Cramer on Mad Money often tells new investors to do this exact thing. especially if a stock has run up too far too fast. What this means is that you take out your cost basis and you leave your profit or the house's money in the trade. Traders and investors lock in profits for many different reasons, but oftentimes it's to reduce risk. Long-term investors may lock in profits to maintain their portfolio balance. For example, an investor may have started with a portfolio divided equally among 5 funds. If one fund outperforms, its portfolio allocation might grow from, say, 20% to 30%, which exposes the investor to added risk. The investor may lock in the profit for a position of the outperforming fund and redistribute the proceeds among the other 4 funds to maintain an ideal portfolio allocation that minimizes risk and maximizes profits. Many actively managed ETFs, like Cathie Wood's ARK Invest, rebalance their portfolios frequently. Just think, if they didn't, their portfolio would be 90% weighted towards Tesla. Short-term traders often lock in profits to generate income and reduce risk. For example, a trader may open a long position after a bullish earnings announcement with a series of price targets. After the stock reaches the first price target, the trader may lock in profits for 1/3 of the position and continue to hold the other 2/3 of the position until a higher price target is reached. This way, the trader is taking some money off the table and reducing their risk if the stock were to suddenly. Be sure to go to tickertimenews.com for more investment strategies in stock market news and to claim your free stocks from Robinhood and we. And finally, risk management technique number 3. And this is the easiest one you can do. You can even do it if you're using Robinhood as your investment broker. Setting a stop loss. Even the most successful investors do not hit a home run on every trade. If you play the stock market long enough, you will buy a few losers, and that's okay. Setting a stop loss price for the stocks you buy is one of the most effective ways to reduce your risk and cut your losses. You can approach the stop loss process in a number of ways: the percentage way, the support way, the moving average, the trailing average, and we're going to go through those right now, starting with the percentage method. The percentage method is by far one of the simplest ways to reduce risk. All you have to do is determine the percent of the stock price you are willing to lose before you exit your trade. This can be any percent you want, from 5% to 30% to 50%. You pick. It's all about your risk tolerance. The support method. The support method is slightly more difficult to implement than the percentage method. To use this method, you need to be able to identify the stock's most recent level of support on their stock chart. Once you have done that, all you have to do is place your stop loss just below that level. For example, if you own a stock that is currently trading at $50 and you identify $44 as the most recent support level, you set your stop loss just below $44. You may be wondering, why you wouldn't just set your stop loss at $44. Why just under $44? That's a good question. Thank you for asking. The reason is you want to give the stock a little bit of wiggle room before deciding to exit your trade. Support and resistance levels are rarely accurate to the penny, but they are pretty accurate to the dollar. So it is important to give the stock some space to come down and bounce back off of its support level before pulling the trigger to exit the trade. Trailing stop loss. This is the most easiest way to reduce your risk. You can set this up in your Robinhood brokerage account. All you do is pick whether you want to set your stop loss using a percentage base or a dollar base. For example, if you decide to set your trailing stop loss as percentage base, let's say at 5%, as the stock rises, your trailing stop loss moves up with the stock price. So if the stock goes up 20%, your trailing stop loss also moves up 20%. Your trailing stop loss doesn't trigger until the stock falls by the 5% that you set already. Either way, whichever stop loss method you decide to use, it should be an integral part of your risk management strategy. The stock market is a great place to invest, and I wish more people were involved in investing. But profits are far from guaranteed. You need to have a sound risk management strategy in place. One that encompasses everything from stop loss to reaping the profits that you have already accumulated. I hope you found a ton of value in this video. I hope you can put some of these risk management techniques to use right now. Leave a comment down below if you have any questions about a risk management strategy. Please make sure to like the video, subscribe, and I will see you in the next video. Take care.